Ever thought about making money with stocks? Well, it's possible and easier than you think. Start by demystifying what the stock market is. Picture a bustling marketplace, but instead of selling fruits, vegetables, or clothes, people are buying and selling pieces of companies. That's the stock market for you, a dynamic, ever-evolving marketplace where shares of public companies are traded. You buy a stock, you're essentially purchasing a tiny piece of a company. This makes you a shareholder, giving you a claim on part of the company's assets and earnings. Pretty cool, right? Why would you want to own a piece of a company? There are two main reasons. First, you can make money when the stock's price increases. This is known as capital appreciation. Let's say you buy a stock at $20, and after a year, it's worth $30. If you sell it, you've just made a $10 profit per share. Multiply that by the number of shares you own, and you can see how the numbers add up. The second way to make money with stocks is through dividends. Some companies, especially those that are well established, distribute a part of their earnings back to the shareholders. These payments, known as dividends, can provide a steady income stream, even if the stock's price doesn't move much. It's worth noting that the stock market isn't just about making money. It's also about contributing to the economy. When you buy stocks, you're providing capital that companies can use to grow and innovate. In return, as the company thrives, so does your investment. However, like any marketplace, the stock market comes with its fair share of risks. The price of stocks can go down as well as up, and there's never a guarantee of making a profit. But with a strategic approach, informed decisions, and a bit of patience, the potential for growth is significant. You see, the stock market presents a fascinating opportunity to grow your wealth. But how exactly do you go about it? The first step to making money with stocks is to educate yourself. Just like you wouldn't set off on a journey without a map, you shouldn't dive into the stock market without understanding its terrain. Let's start with some fundamental concepts. One of these is earnings per share, or EPS. It's calculated by dividing a company's profit by the number of outstanding shares of its common stock. It essentially represents a company's profitability. A higher EPS often suggests a more profitable company, which could make it an attractive investment prospect. Next up is the price-to-earnings ratio, often referred to as the PE ratio. This is the price you pay for each dollar of a company's earnings. In other words, it's a valuation ratio, which helps investors decide if a stock is over or underpriced. A high PE ratio might mean the stock's price is high relative to earnings and possibly overvalued. Conversely, a low PE ratio might indicate that the current stock price is low relative to earnings, possibly making it undervalued. The third key concept to grasp is the dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. If a company's stock yields high dividends, it could be a sign of financial health, or it might indicate that the company doesn't have suitable growth opportunities to reinvest its profits. But it's not enough to just understand these terms. To be successful in the stock market, you need to stay updated with financial news and trends. This doesn't mean you need to glue yourself to the financial news 24/7. But it does mean regularly checking in on the world of finance, keeping an eye on market trends, and understanding how global events might impact your investments. Remember, the stock market isn't a get-rich-quick scheme. It's a long-term game that requires patience, discipline, and continuous learning. The more you know, the better your decisions will be, and the closer you'll get to reaching your financial goals. Knowledge truly is power when it comes to investing in stocks. With knowledge in hand, you're ready for the second step, setting your investment goals. Now, why is this so crucial? Well, clear and realistic financial goals are like your compass in the vast ocean of the stock market. They help you navigate and make informed decisions, anchoring your actions and strategies. Your goals should reflect your personal financial situation and risk tolerance. Are you saving for a comfortable retirement or a down payment on a house? Or perhaps you're aiming for financial independence at an early age. The answers to these questions will shape your investment strategy. Keep in mind, investing isn't a one-size-fits-all game. It's tailored to you, your dreams, your financial health, and how much risk you're willing to take. So take the time to reflect, plan, and set your goals accordingly. Remember, having a clear target helps you stay focused on your investment journey. Now that you're educated and have your goals set, you're ready for the third step, choosing the right stocks. Imagine this. You're in a bookstore filled with countless books, each promising a compelling tale. But how do you pick the right one? It's a similar situation with stocks. The market is filled with thousands of stocks, each with its own potential for profit. But just like choosing the right book, choosing the right stocks requires a bit of strategy. The first strategy is to analyze a company's financial health. This is like reading the book's synopsis. You want to look at the company's earnings, debt, cash flow, and other financial indicators to determine if it's financially sound. If you're seeing a lot of red flags, it might be best to skip that particular book. Next, seek to understand the company's business model. This is akin to understanding the genre of the book. Is the company in a growing industry? Does it have a unique product or service? How does it make money? These are the kind of questions you want to ask. Lastly, evaluate the company's competitive position within its industry. This would be like reading reviews and ratings for your book. Is the company a market leader? Does it have a competitive advantage over its peers? The stronger the company's position, the better its potential for long-term success. Remember, choosing stocks isn't just about picking companies with the highest returns. It's about selecting companies that align with your investment goals and risk tolerance. It's about finding those books that you believe in and that you're confident will deliver a good story in the long run. It's important to note, however, that even the most strategic stock selection can't guarantee profits. The stock market is unpredictable and influenced by many factors beyond our control. But by doing your due diligence, you can increase your chances of making a wise investment. Choosing the right stocks is a crucial step in making money in the stock market. Like choosing the right book, it requires careful consideration and strategic thinking. But when done right, it can lead to a profitable and rewarding investment journey. The fourth step to making money with stocks is diversifying your portfolio. Now, what does diversify mean in the context of investments? To diversify is to spread your investments across various sectors, industries, and types of stocks, rather than putting all your eggs in one basket. Think of diversification as an insurance policy for your portfolio. It's a strategy designed to manage risk and increase the potential for returns. By spreading your investments, you're less likely to suffer significant losses if one particular sector or stock performs poorly. Imagine investing all your money in a single sector, let's say technology. If the tech sector takes a hit, your entire portfolio is at risk. But if you have also invested in healthcare, consumer goods, and utilities, the impact of a downturn in technology is cushioned by the performance of your other investments. Diversifying doesn't stop at spreading investments across sectors. It also means investing in different types of stocks. You could consider a mix of growth stocks which have the potential for high returns, but come with more risk, and value stocks, which may not grow as quickly, but are often more stable. Remember, diversification isn't about chasing every hot tip. It's about creating a balanced portfolio that aligns with your investment goals and risk tolerance. Diversification is your safety net in the unpredictable world of stocks. The final step is to monitor and adjust your portfolio. This is not a set-and-forget situation. The stock market is a living, breathing entity. It changes, it evolves, and your portfolio should do the same. Now imagine you're a gardener. Your portfolio is your garden. You've planted a variety of seeds, that's diversification. But do you walk away hoping for the best? No. You water, you weed, you watch. You see what's thriving, what's struggling, and you adjust accordingly. That's exactly what monitoring and adjusting your portfolio is all about. Regularly reviewing your portfolio's performance is crucial. You need to know how your stocks are doing. Are they meeting your expectations? Are they helping you reach your financial goals? If not, it might be time for a change. But remember, change doesn't mean panic. The stock market will have its ups and downs. Don't let a bad day or a bad week scare you off. Instead, look at the big picture. Is there a consistent pattern of underperformance? Has there been a significant change in the market or in the company? And it's not just about the market. Your personal financial situation can change too. Maybe you've got a new job or there's a baby on the way. Your portfolio should reflect these changes as well. Keeping an eye on your investments and making smart adjustments along the way is the key to sustained success in the stock market.